In the world of options trading, a covered call stands out as a strategy favored by investors seeking consistent income with limited risk. It involves selling call options against shares of stock you already own. This strategy allows you to generate income from the option premium while still holding on to your stock position. However, it's essential to understand the mechanics of covered calls before diving in. A call option gives the buyer the right, but not the obligation, to purchase a specific stock at a predetermined price, known as the strike price, on or before a set date, the expiration date. When you sell a covered call, you are essentially selling someone else the right to buy your shares. The covered part of a covered call refers to the fact that you already own the underlying stock. This is a crucial aspect of the strategy as it limits your potential losses. By owning the shares, you are covered if the option buyer decides to exercise their right to buy the stock. Covered calls are considered a bullish income strategy. This means that they are most suitable when you have a neutral to slightly bullish outlook on the underlying stock. By selling covered calls, you are essentially betting that the stock price will either stay flat or rise moderately. The income generated from covered calls comes from the option premium received when you sell the call option. This premium represents the price that the option buyer is willing to pay for the right to purchase your shares. Since you are selling away the upside potential above the strike price, covered calls are not ideal for investors seeking significant capital appreciation. However, they can be an excellent way to generate consistent income from stocks you already own or plan to hold for the long term. One of the most appealing aspects of covered calls is their defined risk and reward profile. Unlike some other options strategies, covered calls have both a maximum potential profit and a maximum potential loss. The maximum profit from a covered call is limited to the premium received when selling the call option. This profit is realized regardless of how high the stock price rises above the strike price. On the other hand, the maximum loss is limited to the purchase price of the stock minus the premium received. This limited risk profile makes covered calls an attractive strategy for investors who are looking for consistent income with a defined downside. However, it's crucial to remember that even with limited risk, covered calls are not without their downsides, which we will discuss later. Let's illustrate the covered call strategy with a real-world example using Chevron or CVX stock. Suppose you own 100 shares of CVX, which is currently trading at $150 per share. You decide to sell one covered call option with a strike price of $160 expiring in 1 month. You receive a premium of $5 per share for selling the call option. In this scenario, your maximum profit is limited to the premium received, which is $5 per share, or $500 in total, 100 shares times $5 per share. This profit is realized if CVX's price remains below $160 by the expiration date. If the price goes above $160, your shares will likely be called away, and you'll keep the premium and the profit from selling your shares at the strike price. Your maximum loss, on the other hand, occurs if CVX's price drops to zero, which is highly unlikely. In this worst-case scenario, your loss would be limited to the purchase price of your shares, $15,000 minus the premium received, $500, totaling $14,500. Entering a covered call trade involves two primary steps: owning the underlying stock and selling the call option. First and foremost, ensure you have a brokerage account approved for options trading. Not all brokerage accounts offer this functionality, so confirming this early in the process is essential. Once you have a brokerage account, you'll need to purchase the underlying stock if you don't already own it. In our Chevron example, you would buy 100 shares of CVX. After the shares are in your account, you can then sell or write the call option. When selling the call option, you'll need to specify the number of contracts, the strike price, and the expiration date. Each option contract typically represents 100 shares of stock, so in this case you'd sell one contract to cover your 100 shares. You'll receive the premium up front as soon as the trade is executed. Exiting a covered call position before expiration can be done in several ways, each with its own implications. The simplest way is to buy back the call option you sold. This is known as closing the position, and it neutralizes your obligation to sell the stock. Another way to exit the position is to sell your shares in the open market. However, if the stock price is above the strike price, the call option buyer may exercise their right to buy the shares, and you'll be obligated to sell. Timing is crucial when exiting a covered call. If the stock price has gone up significantly, buying back the call option can be expensive. Conversely, if the stock price has dropped, you can buy back the option at a lower price, reducing your overall loss. Time decay, the covered call's silent partner. Time decay, also known as theta, is a critical factor to understand when trading covered calls. It refers to the rate at which an option's value erodes as it gets closer to its expiration date. Options are wasting assets, meaning their value diminishes over time. For covered call sellers, time decay works in your favor. As the option approaches its expiration date, its value decreases, allowing you to buy it back at a lower price or let it expire worthless. This is why covered call writers often choose shorter-term options, as the rate of time decay is faster. However, it's important to note that time decay is not linear. It accelerates as the expiration date approaches, meaning the option loses value at a faster rate in the final days and hours before expiry. Advantages of covered calls, income and downside protection. Covered calls offer several advantages, making them a popular choice for both novice and experienced options traders. One of the most significant advantages is the potential to generate income from stocks you already own. This can be particularly appealing in sideways or slightly bullish markets where the potential for significant capital appreciation is limited. Another advantage is that covered calls offer a degree of downside protection. The premium received from selling the call option provides a cushion against potential losses in the underlying stock. This can be especially beneficial in volatile markets where stock prices can fluctuate significantly. Additionally, covered calls can be a more conservative approach to options trading compared to strategies like buying calls or puts. Since you own the underlying stock, your maximum loss is limited, making it a less risky approach than naked options trading. Disadvantages of covered calls capping profits and upfront costs. Despite their numerous advantages, covered calls also have some drawbacks that investors should carefully consider. One of the main disadvantages is that they limit your profit potential. If the stock price rises significantly above the strike price, your profit is capped at the premium received when selling the call option. Another disadvantage is the upfront cost of purchasing the underlying stock. For investors with limited capital, this can be a significant barrier to entry. Additionally, if the stock price declines significantly, you will experience losses on your stock position, even though the premium received from the call option may offset some of those losses. Furthermore, covered calls require active management, as you need to monitor the position and make adjustments as the stock price fluctuates and the option approaches expiration. This can be time-consuming, especially for investors who are new to options trading. Conclusion: mastering covered calls for consistent returns. Covered calls offer investors a compelling strategy to generate income and manage risk within their portfolio. By understanding the mechanics of covered calls and carefully considering the potential risks and rewards, investors can utilize this strategy to enhance their returns and achieve their financial goals. Remember, like any investment strategy, covered calls are not without risk, and it's crucial to have a firm grasp of options trading principles before implementing them. Conduct thorough research, consider your risk tolerance, and never hesitate to seek guidance from a qualified financial advisor. With careful planning and execution, mastering covered calls can be a valuable tool in any investor's arsenal, providing both consistent income and a degree of downside protection. Thanks for watching, and do not forget to like and subscribe. See you next time.